Welcome, I'm the Options Overlord, and this is how to trade the wheel strategy. This is the income loop that ties two strategies together, two premium streams on stocks you actually want to own. It is the natural next step after covered calls. Let us get to work. First, the ground rules. Everything here is education, not personalized financial advice. Options carry substantial risk. They are not for everyone, and you can lose money. The data I show is believed reliable, but comes with no guarantee. Do your own research, speak to a licensed advisor, and own your decisions. Good. Now let us trade. What is the wheel? It is a continuous two-phase loop. You sell cash-secured puts on a stock you would happily own, and you collect premium. If you are assigned, you switch to selling covered calls against those 100 shares until they are called away. Both phases pay you, then the cycle repeats. Get paid to buy, get paid to hold. One caution up front, it is capital intensive. A $100 strike ties up $10,000. This is a balance sheet strategy. The mechanic, 5 steps. 1. Sell a cash secured put on a quality name at your buy price and reserve the cash. 2. The put outcome. Above your strike, you keep the premium and repeat. Below it, you are assigned 100 shares. 3. Sell a covered call above your adjusted basis for more premium. 4. The call outcome. Below the strike, you keep premium and shares. Above it, the shares are called away. 5. Spin the wheel again. Gains banked, capital freed, open a fresh put. The loop continues as long as you want it to. Let us walk one full turn. Illustrative. A quality blue chip at 105. Phase 1, you sell the $100 put. 30 days out for $2.50. That is $250, and you reserve $10,000. Your break even is $97.50. with about a 70% chance the put expires worthless. Now say you are assigned at 100. Phase 2, you own 100 shares and you sell the 110 call for $1.50, another $150. Your adjusted basis is now 96. If the shares are called away at 110, the best case, both legs pay you $400 in premium plus $1,000 in capital gain. $1,400 on $10,000 reserved, about 14% for the cycle. Illustrative, not a forecast. Look at the risk on phase 1, the put. Above 100, the put expires worthless and you keep the full $250. Your break-even is $97.50. Below 100, you are assigned at an effective $97.50, and you move to phase 2. And the tail, the maximum loss is $9,750, only if the stock goes to zero. So wheel only names you would hold through a real drop. 2 outcomes in each phase, and every branch pays you. Phase 1, the stock holds, you keep the credit and repeat. Or you are assigned and move on with an effective cost of $97.50. Phase 2, the stock stays below your call. You keep premium and shares. Or it is called away and you bank the gain plus all the premiums, then reset the wheel. There is no branch where you do not collect. That is the beauty of it. When to use it? When you actually want to own the stock. That is the golden rule. Never wheel a name you would not hold through a 20% drawdown. When you are long-term bullish on a profitable blue-chip business. When volatility is elevated, IV rank 30 to 50, and watch the VIX as a quick proxy. When you have the capital, plan 10 to 20,000 per position. When sector and quality favor durable cash flow names. And when you will respect earnings. Always close or roll before a binary event. The risks, and there are real ones. Capital tied up in cash, not just margin. Bag holder risk. If a stock crashes, you bought high and you are underwater, and calls above basis may pay pennies. Capped upside. 2 premiums cost you the ceiling. Strike selection matters. Default to about a 0.30 delta. Taxes are real. Assignment and called away are taxable events. Treatment varies, so get local advice. And the upside, dual income streams. You earn while you wait to buy, while you wait to sell. Few strategies do both. 6 best practices. Aim for 30 to 45 days to expiration and close at 50% of max profit. Sell about a 0.30 delta put, roughly 70% odds out, and avoid anything above 0.35. Quality over yield. Profitable, free cash flowing businesses only. Never wheel through earnings, close or roll first. Use the 50% profit rule to free that 10,000 sooner. And track your adjusted cost basis. Sum every credit, both phases, and never sell a call below basis. That one rule prevents most blow-ups. Let us go deeper on the one thing that makes the wheel work over time. Cost basis. Every credit you collect permanently lowers your effective entry. Sell a put for $2.50, the stock holds. Sell another for $2, then you are assigned. Sell a call for $1.50. Your basis is now 94, while the stock is at 105. That is an 11% cushion before any unrealized loss appears. And the discipline that protects you, never sell a covered call below your adjusted basis. If the stock dumps, wait for a green day, then sell above basis. Patience protects capital. Managing the position. Taking profits. The 50% rule, sold for $2.50. It is now $1.25. Buy to close and free the reserve. Or get called away, the win, bank the gain plus all premiums, and reset. Do not chase the stock higher. And accepting assignment, remember, it is step 2, not a loss. You bought a stock you wanted at the price you chose, with premium already lowering your cost. Confirm the shares, update your basis, wait for a green day, and sell a call above it. Never panic sell, and never sell calls under basis. Rolling, and only ever for a net credit. Roll down and out on a threatened put, lower strike, later date, to pull your price down and buy time. Roll up and out if a covered call is breached on a rally, or simply accept and manage, take assignment and grind your basis down by selling calls above it. Here is a roll down and out example. You sold a $100 put for $2.50. The stock fell to $1.01. The put is now $3.50. You close it and open the 97 put 60 days out for a 20-cent net credit, a $3 lower strike, and 30 more days and you were paid to do it. 6 mistakes. Wheeling junk for premium. Chasing high IV on dying names. High IV is the market's warning. Selling calls under basis. Locking a loss for $50 is the costliest mistake here. Over leveraging. Puts needs a full cash backing. Keep 20 to 30% in reserve. Ignoring dividend risk. A deep in the money call before ex-dividend invites early assignment. Wheeling through earnings. A miss can gap 15 to 25%. And quitting after one bad trade. The wheel is a long cycle compounder. One assignment is step 2, not failure. Quick glossary. Cash secured put, covered call, assignment, called away, adjusted cost basis, theta, delta, and implied volatility. Pause here if you want them to stick. The two that anchor the wheel. Assignment is step 2, not a failure, and your adjusted basis falls with every single credit you collect. So master the wheel. You generate dual stream income on stocks you actually want to own. You acquire quality companies below market at the price you choose, and you compound premium in both phases to lower your basis over time. Educate, discipline, execute. Where to go next? Watch the covered call video, the bedrock of the wheel. Master phase 2 first. Go deeper in the Overlord's covered call playbook. 3 stages, 9 steps. And use code YT100 for $100 off. And stay current with the weekly US market updates. Thank you and good luck with your trading. I am the Options Overlord. Educate, discipline, execute.